One of the very important matrices is beta, and we discuss it in this lecture. Beta is relevant for any stock market trading. We will look at it from the perspective of mutual funds. Now the concept of beta comes from capital asset pricing model, CAPM. We will very briefly look at what is CAPM. Studying CAPM by itself will require an entire course. Beta is the sensitivity of the expected excess asset returns to the expected excess market returns. Now asset return here means the returns from the mutual fund, and the market returns means what we can expect to get from the market. Beta is the measure of volatility or systematic risk of an individual stock in comparison to the unsystematic risk of the entire market. Like we have studied in the previous section, systematic risks is something which cannot be done away with. They are always existent in the market, and these cannot be taken away through measures like diversification, etc. So this is systematic risk is always available in the market and always prevalent rather in the market, and nothing can be done about it. It is to be lived with. So beta measures the volatility, how much of systematic risk there is in the market for an individual mutual fund in comparison to the unsystematic risk of the entire market. As you would have understood by now, since beta is a measure of volatility, beta is essentially a measure of risk. So beta measures how risky a particular mutual fund is in comparison to other mutual funds. In layman's term, we can understand that if beta is high, then the mutual fund is more risky, and if beta is low, then the mutual fund is less risky. Beta is interpreted as follows. If beta is equal to 1, then the mutual fund is as risky as the current market situation is. If beta is greater than 1, then the mutual fund is more risky as compared to the market. If the mutual fund is more risky as compared to the market, it means that we should expect more returns from the mutual fund as compared to what is the returns we can expect from the market. Similarly, if beta is less than 1, then the mutual fund is supposed to be less risky as compared to that of the market. So, if beta is less than 1, we should expect less returns from the mutual fund as compared to the returns we would expect to get from the market. Now, beta can be less than 0 also. If beta is less than 0, it means the mutual fund returns will move in the opposite direction to that of the market. Now, let's look at the formula for calculating beta. We will study two formulae by which we can calculate beta. First, let's look at the formula that is stated here. So, beta is equal to covariance between the returns from the mutual fund and the returns from the market divided by the variance of the returns of the market. Let us take a mutual fund arbitrarily and see how to calculate the beta for that particular mutual fund. So, we require two values. One is return from the mutual fund and return from the market. Now, in the lecture on mean, we have seen how to calculate the return from the mutual fund. We will use the same strategy. Now, to get the values of the NAV for the mutual fund, I will explore one site. There are many sites where this is available, but I will show you from one side how this information can be gathered. For gathering the historical data regarding Sensex, we will use the website www.bseindia.com. Now we open this site. Now in this site, we can see there is something called indices. So we will click on that. Look at the site address properly. Okay. We click on indices. Now here we select the historical prices. So it asks me which index. So I say BSE Sensex. I want monthly data from January 2016 and click submit. So all the data is presented here from January 2016 on a monthly basis. This data can be downloaded also. So I will download this data and utilize it. Next, we gather the data for NAV of a mutual fund. This we can get from a website called www.amfiindia.com. So we open this website. Here you can see the website. Now first we select the fund house. So this is Axis Mutual Funds. Then we specify the fund name. So we are trying to select Axis Long Term Equity Plan, the equity fund. growth plan. Now this is little bit more tedious because I have to give 3 months intervals because it allows for maximum 90 days of NAV. So I will give every 3 months interval from 2016 onwards to gather all the NAV for this particular fund. So let us see, I provide a 3 months interval. So there I get the NAV for this particular mutual fund. Now I have taken all this data and put it in an Excel sheet. So here you can see the different months. Now here is the Sensex data and here is the NAV data for that particular mutual fund. We will freeze this pane so that the screen doesn't move around. So we have done that. Now we will consider that we purchase 100 units on the 1st of January 2016. So 100 units. So let's first calculate the time intervals. Like we have seen in the discussion on mean, we need the time intervals for calculating the returns. So we calculate the number of time intervals in terms of number of years. So I will copy this down. So now the time intervals have been calculated. Next, let's calculate the purchase price in case we buy 100 units of the Sensex. So we know that the purchase has to be negative value because it's an outflow of money. So we will subtract by 0. Okay, now let's calculate the value as on the different months. So this is simple, just multiply the 100 quantity by the value of the Sensex and then I will copy this across for all the other months. So there we have the value from 1st January to 1st January 16 to 1st January 19. Now I will just copy this in the next column. So this gives the purchase value for the mutual fund. So once we have this, we can calculate the CAGR, that is the returns on the different months. So we will use the same formula, same function called rate. We will give the time interval, the installments are 0, the present value is the purchase price and the future value is the value as on that particular month. So we will copy this down. We will do the same thing for the mutual fund also. Okay, so now we have the returns from the Sensex as well as we have the returns from the mutual fund. Next thing we have to do is find the covariance between these two returns. So for covariance we use the function covar in Excel and this function requires two arrays to be provided. The first array we provide is the Sensex returns. The second array we provide the returns from the mutual fund. So we have got a covariance now. Next we find the variance of the market returns, that is the returns from the Sensex. So we find the variance using the var function. Okay, now we have got the covariance of the covariance as well as we have got the variance. Now we calculate beta as covariance divided by the variance of the market. So there we get the beta. Now we see another way of calculating beta. This time we will utilize capital asset pricing model. Now capital asset pricing model is a theoretical model. It has not been proved, but however it is very widely used and it is by far the most popular pricing model. Now it's a pricing model which is used to determine the appropriate rate of return of an asset to make decision regarding whether that asset needs to be added to the portfolio or not. The formula for CAPM is as shown here. RA is equal to RF plus beta into RM minus RF. Now here RA is the return on the asset. So how much return we can expect from the asset. Now to determine that, RF is the risk-free rate. Risk-free rate is normally taken as the rate at which we are assured to get a return. In every country, normally the returns from our government bonds are considered to be risk-free. So we normally take the rate of return of a government bond to be the risk-free rate. RM, like we have seen just some time back, is the rate of return from the market that we can expect. So when we have the value of rate of return from the market, RM, we can assume a risk-free rate based on the situation in the country, RF, and we have the rate of return on the asset. Then we can calculate beta by rearranging this formula as RA minus RF divided by RM minus RF. Let us calculate beta according to this formula. So we will return to our Excel. Now we use the same Excel that we used for calculating beta earlier. First thing is we will consider risk-free rate to be 4%. This is in the Indian context, 4% is a fair idea regarding the risk-free rate that is prevalent in the country. Now we just discussed that the formula for our CAPM is RA is equal to RF plus beta into RM minus RF. So from this formula we can get that beta is equal to RA minus RF divided by RM minus RF. So first let us determine RM. RM is nothing but the average of all the returns that we have computed for the Sensex. For the same time period, we consider RA, which is the average of all the returns that we have got from the mutual fund. So now we have got RM, RF and RA. Let's calculate beta using the formula that we have just discussed. Divided by RM minus RA. So we see that the beta is fairly close to the beta we had earlier calculated. So we have seen two ways how we can calculate beta. Now beta is based on historical values of returns. That's why it is very good for predicting short-term risks in a mutual fund. However, it is not very useful for predicting on a long term what would be the mutual fund's price be. With that, we come to the end of the discussion on beta. Thank you for listening. See you in the next lecture.